We expect a move at the March FOMC meeting, and then quarterly moves March, June, September, and December. We actually just made a change in our forecast for the later part of the year. We pulled forward the start to balance sheet runoff, so quantitative tightening as it's sometimes referred to, from the December FOMC meeting to the July meeting, in response in part to the strong data, but also to what we saw in the FOMC minutes last week about how the committee is thinking about runoff. They seem to be more anxious to get started. And so we pulled that forward, and we added an interest rate hike in December. Previously, we thought that start to runoff would substitute for a quarterly hike. But in the middle of the year, that's a little bit less plausible, I think, because the inflation is still going to be probably so far above the Fed's target that I don't think they would not hike because they're starting runoff. So that makes it 4 hikes through the year. How good a job have they done? I think they did a really terrific job in 2020 in responding very quickly and very aggressively to what could have been a very serious crisis. Obviously was a very serious crisis as far as health is concerned, as far as the economy is concerned, a serious crisis. But in financial markets, they stabilized financial markets, they eased financial conditions aggressively, and I think that had a very important impact in terms of short-circuiting what could have been very nasty second round effects. I think in 2021, it's been tougher, especially I would say in the last 6 months. They've been behind in terms of expectations for inflation and for the recovery in the labor market, and so they've been sort of scrambling to catch up. I mean, it's not so far out of line with where a lot of private forecasters have been. I mean, there have been a lot of surprises, but so they've been in a similar position. But that's made it harder for them, obviously, to communicate that sort of shift well. I think under the circumstances, given that the forecast had to be changed pretty significantly, they've done a pretty good job in communicating how their thinking was evolving. But this is, a difficult period when you have changes and twists and turns and significant turns that need to be carried out in monetary policy. That's always a hard period, and it'll continue to be challenging, I think, as we go through 2022.
Well, 2022 has already started out as quite a turbulent year, especially if you were involved in the tech sector. And just over a week into the year, we've seen a massive sell-off in U.S. tech stocks, with the NASDAQ crossing into correction territory in recent trade. And we know that there's a lot of retail money involved in markets right now, especially in these tech stocks. And I wonder if, from the Fed's perspective, this could influence their policy trajectory, given the potential destabilizing effect of having all these investors' money wiped out.
Well, certainly financial conditions are very, very important, because the way that monetary policy is transmitted to the real economy isn't through the direct effect of the federal funds rate. It's really through the impact that the Fed is having on longer-term interest rates, on exchange rates, on credit spreads, and also on the equity market. So big equity market moves, especially if they diverge from expectations, can have a feedback effect onto monetary policy. So if you were to see a large move in equity prices, then of course the Fed would take that into account and potentially steer a somewhat more moderate course. So far, I think what we've seen probably doesn't quite rise to that level. We have obviously seen weaker performance, some quite a bit of volatility to the downside, but overall financial conditions still haven't really tightened significantly. They've been, according to our index of financial conditions, been sort of in a range over the last 6 months. And I would expect them to gradually tighten through some combination of higher interest rates, probably somewhat wider credit spreads, probably weaker equity markets, at least in terms of the rate of increase. I mean, our equity strategists still expect positive price returns as we go through 2022, but at a much slower pace than last year. And of course, that is at risk of being punctuated by sort of drawdowns along the way.
Hi, I'm Julianna and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.